For those of you who don't know me, I'm Uday Turaga. I'm founder and CEO of ADI. Thank you for joining us here today. Looking forward to 3 days of great programming. Thanks to all the speakers who have kindly agreed to come and speak at the ADI Forum. This is the 8th ADI Forum. It's always a pleasure putting the forum together, curating the speakers, looking at the topics that we want to talk about, and bringing everyone here together. Every year the forum has expanded over the last 8 years, and it's great to see everybody who has been supporting us at this event over the years. I want to thank our partners and sponsors who are listed here. A lot of them support us every year, and we are deeply grateful for their support. It's not possible to run a conference here today without companies supporting you, and we are deeply grateful to everybody here. Most of them are here, so I hope you'll take a minute to connect with them, network with them, and learn a little bit more about their businesses. These are great companies, great businesses with very interesting perspectives. So deeply grateful to them for the support and looking forward to engaging with them here over the next 3 days. So we have great programming lined up here over the next 3 days. We're going to kick off Oil and Gas Day today here. Brad Childers, who's the CEO of Archrock, is going to be the keynote speaker here today. Then we'll do ADI's outlook for the oil and gas industry. And then we have 4 panel sessions. We'll have a panel session on upstream oil and gas, on natural gas and LNG, and then follow up with 2 panel sessions in the afternoon, one on fuels and refining, and the last panel session will be on midstream and NGLs. A slight change in the programming is we've switched the fuels and refining and midstream panels primarily because of a conflict with one of the speakers, but it's going to give us a nice perspective of where the oil and gas industry is today. What should we be looking for? It'll be a perspective that will be value chain wide, right? So that's one of the ways in which the ADI Forum is different, is we don't focus exclusively on, let's say, upstream or midstream. We kind of take a value chain wide strategic perspective in alignment with a lot of the strategy work that we do for the oil and gas, energy and chemical industries. Tomorrow is Energy Transition Day, similar layout and format. We have Charles Sherrington, who is co-founder of Archrock, one of the largest decarbonization funds. They have built an incredible portfolio of businesses over the last few years. And these are profitable businesses in the energy transition space, which is important for us to understand. One of their portfolio companies, for example, is Priority Power, which has been a partner for the ADI Forum for many years, and they're going to be here. But that's one example. We are quite excited that Charles is going to be here tomorrow. And then similar to Oil and Gas Day, we kind of follow the value chain. We'll have a panel session on renewable power and utilities. Then we'll talk a little bit about biofuels, sustainable aviation fuels, renewable natural gas. We'll have a panel session on hydrogen and carbon capture. And then we'll wrap it up with a panel session on energy transition infrastructure. So that's for tomorrow. And then finally, the third market that we serve is, the third market that we serve is chemicals. From our acquisition of Chemical Market Resources now about 7 years ago, and that's on Thursday. And we have Marianne Maximus from LyondellBasell, who leads their mechanical recycling and feedstock strategy for their recycling businesses. We have her keynote in the afternoon at 2 p.m. But again, similar format. We'll do an outlook for the industry in the morning, and then we'll have panel sessions from feedstocks through engineered and specialty chemicals and materials, plastics and polyolefins, look at feedstock issues, and then finally wrap up with sessions on innovation and investor perspectives. So that's the agenda for the next 3 days. We have roughly 40 speakers with very interesting perspectives. That's one thing that we at the ADI Forum are very proud of, is this is a very content-driven conference. We like to bring people who have interested, differentiated perspectives, who are participating in different parts of the value chains in oil and gas, energy and chemicals. And that perspective, we think, is the way we need to learn about what is truly happening in the industry. Media is not there at the conference, so this allows speakers to talk a little more freely, openly, and have good discussions around it. Every panel session will end with a Q&A that's open, so there'll be a microphone floating around so you can ask questions. Gives us an opportunity to engage these speakers more directly. So we're going to fix some of the issues with this here shortly, but very quickly, I want to give a big shout out to our team here that works on the forum. Every year, the forum team puts in a lot of energy, and every year, as the forum has gotten bigger, more people who are supporting us on this event. Everybody here, you see the analyst pool that has truly put all our decks, put in a lot of energy in pulling all our decks together. Each of our panels starts with a few slides with ADI research on what's happening in the market. So that's where you'll see a lot of their work. The ops team here, led by Faiza Tanveer, who has been the forum producer right from the first forum when she was the only person handling everything. They have done an incredible job of pulling this together. So deeply grateful to these guys. If I look good here today, it's because of them. And if there are areas where we can get better, please let me know. For those of you who don't know us, I have a few slides that very quickly, and then we'll get into the keynote presentation here. But ADI, we are a boutique consulting firm. We actually celebrated 15 years last year. We focus on 3 markets: oil and gas, energy, and chemicals. Within these markets, we work across the value chain. So oil and gas, we work in upstream, midstream, natural gas, LNG markets, fuels and refining. Similarly, in energy, chemicals, we work across the value chains. We've been around for 15 years, so we've had the opportunity to serve over 350 clients. We have completed over 1,000 projects over the last 15 years. Most of the work that we do is consulting work. So clients come to us with a question or a problem. We put a team around it and execute around that question over anywhere from 4 to 12 weeks. So this can be a broad range of questions. We just finished a 12-week engagement that's focused on developing a feasibility study for a new sustainable aviation fuels plant in Asia and the Middle East. We just finished a project helping an OEM develop their strategy for compressors into the carbon capture market. We just finished a piece of work helping a refiner with their strategy going forward. So there's a broad range of strategy market questions that ADI works on through its consulting offering. That's our primary business. Over the years, as we have grown, we have added subscription research capabilities. We have accumulated a lot of data in all the markets that we serve, and this data we license through our analytics platform. And then finally, we host this conference here, the ADI Forum. So those are the 4 ways in which we go to market. That's our core offerings here. So I'll skip through the rest of this here, but a lot of this is available. It kind of gives you a picture of our capabilities here. But with that, let me get into the keynote presentation here today. Super excited to have Brad Childers here today. He's CEO and president of Archrock. Archrock is a leader in the contract compression space. If you've been following Archrock stock, they have done incredibly well over the last couple of years. Brad's been with the company in different variants or precursors of Archrock for almost over 20 years. Pretty much he spent most of his career there. There's a full bio in there. But with that, let's get started. Brad's going to give us a short presentation, and then we'll have a moderated conversation, and then we'll open it up here for Q&A.
Good morning, everyone. First off, I want to begin by Acknowledging that context is everything, as I walked up a minute ago, I asked if I could get some water, and I didn't realize that the mic was on, and I had a gentleman reach up and say, "You know, you're hot." I'm like, normally strangers don't actually reach up and just tell me I'm hot. But in this context, it was actually a helpful comment. So I want to thank ADI and Uday for inviting me this morning, and for all of you for coming and listening to my remarks. In the context of this conference, Uday gave me 20 minutes for my opening comments. Normally that takes me that long to get warmed up, but I'm going to try to keep my comments to about 20 minutes. And for this conference, I came up with what I think is a different perspective on Archrock, a look at some of the more, what I would say, are under the hood strategies that we've implemented that are showing up in our performance. And as I do this, I want to acknowledge, number one, this is a great market. It's a great market for natural gas. It's a great market for compression, and we absolutely have a tailwind behind us, which we intend to take advantage of. But at the same time, a tailwind only carries a vessel if the vessel is well built and has a great crew. We've been working on the vessel for a number of years, and I happen to have a fantastic team driving performance at Archrock. So I want to lift the hood a little bit and share a different look at what has driven some of our performance. So the discussion today will focus on really four things. First, a short intro into Archrock, who we are, what we're about, but I'm going to really spend just a touch on that because I think in this room, most people understand the position of natural gas compression in our industry. Then I want to review four of what I would say our deepest, maybe hardest to get to strategies that we've implemented to differentiate this vessel that is right now benefiting from this tremendous market. Then a few comments on the market itself, and finally I'm going to close with a perspective of what we're working on currently, in addition to what we've done so far. So if you'd go ahead and advance, please. I do want to point out that we're public, so I will talk about give some forward-leaning information. And as I do, I'm also speaking with a close of Q3 2024 because we have not yet released our Q4 2024 numbers, our year-end results, and we've not provided guidance for 25. So with that, sticking on this slide, as you guys know, natural gas compression, it's a mechanical process to compress gas to provide it the energy to move through pipes or to move down well bores. And fortunately for us, it's ubiquitous and it's absolutely required to transport natural gas. A really important point given the volume of natural gas we see that is going to be produced ahead of us. We have our own fleet of equipment that we place on a customer location and operate for them. We typically do this on a fixed fee, take or pay basis with a contract tenor of initial terms of 3 to 5 years. This provides an incredibly stable platform. Now, what we think of when we think of the work we've been doing to position Archrock well is to leverage a large fleet of horsepower predominantly in midstream operations with a more recent expansion to electrify the oil field. We too are looking at how well we can or how we can electrify our fleet where that's in demand with our customer base. We have high quality customers, typically with relationships that are a decade or more long in duration. And we operate in most every major basin in the US, but with a significant focus on the Permian Basin. We're public, about $5 billion of market cap, and right now we're paying a 19-cent per quarter dividend, and having successfully raised that dividend about 4 times over the last 24 months. We're benefiting from this strong market and trying to make sure we get to share that not just with our customers through great performance, our employees with a great company, but also our investors with strong cash returns. So with that introduction, go ahead and advance the slide, please. Normally, when I speak to this slide, I talk about the pride we have over our 70-year legacy, and that's certainly true. But today, I want to position this as really the problem set. So when you look at this slide, what you see is, yes, we have a legacy that goes back 70 years, but you can see distinct eras of performance. In the 90s, 2 compression companies, Hanover Compressor and Universal Compression, consolidated the market. They did a roll-up, really, taking the compression operations from most of the major service companies through either buyouts or just divestitures. And they built what were the 2 most dominant players in the market from the 80s up through 2007. And you can see some of the names that were consolidated. It really was, most service companies at that time had service production operations, including compression. Then in 2007, those two companies merged to form Exterran. Exterran was a global company that operated in 30 countries, 30 states, multiple product lines, cryogenic plants, production equipment, compression equipment, nuclear reactor certified vessels out of Italy, FPSO topsides out of Singapore. It was a small conglomerate with a lot going on. In fact, we determined it had too much going on and that the businesses didn't actually fit together. There was not enough complementary synergies between that global fabrication business and the U.S. domestic market, as the U.S. domestic market was regaining new steam as the shale plays were really attracting a lot of capital investment. So, decision was made, 2015, to separate the two companies. We spun off all of the global fabrication and global and international services businesses and retained the U.S. domestic service business, rebranded it Archrock. So then as Archrock, we emerged and we still had, and starting as Exterran in the U.S. operation, but as Archrock, we emerged and we saw a few things in the operation still. Number one, even though the businesses had been rolled up, there were still so many competing operating philosophies, systems, and a distinct lack of an operating platform. In other words, it had been a roll-up, but the consolidation work operationally had not yet really fully taken place. And I want to give you a picture of what that looked like, the challenges that were presented. Go ahead and advance to the next slide. So what you can see here is that in 2011, we operated about 835 unique combinations of equipment and configurations of equipment. You can see every bubble represents a configuration. The size of the bubble denotes how many of those we had in the fleet from a quantum and horsepower perspective. But with 835 configurations, you can picture the supply chain challenges, the inventory challenges, the logistics challenges, not to mention the taxing on the field service teams to have the expertise to be able to operate and maintain so many types of configurations of equipment. So it resulted in what is a simple strategy, right? You step back and you look at this, you think of Southwest Airlines, and you think standardization. This is 30-year equipment, so you cannot standardize by turning on a dime. It takes time. But from 2011 through 2024, even though we have grown the business, please go back a slide. Another slide, back, not forward. Back, not forward. Back, not forward. Keep going, stay there. Thank you. So even though we grew the fleet over that period of time, we were able to, through strategic divestitures and the right investments in the right equipment, reduce the number of configurations down to 263. Now this is actually a number that was more like about 170 until our most recent acquisition of TOPS. And so that increased the number of configurations markedly. So I give our fleet strategy and our asset management team great credit for having reduced the complexity of our operations significantly by reducing the number of configurations. And this really alleviated a ton of logistics, supply chain, and inventory issues that we had in the system, and allows for a more uniform training platform for our technicians as well. Next slide, please. Here's a second look, which is that when you look back in 2011, we were operating in about 29 states. Today we're in 15, 478 counties. Today we're in 182. But thank you very much. Thanks very much. But the more significant aspect of this is 2011, 70% of our operations were leveraged on dry gas plays. When you think about all of the consolidation activity that took place from the service companies, all of that was a historical position, which was predominantly dry gas, not growth. So we made the decision of, in addition to converting the equipment, to focusing our geographic investments into the right basins, into the right plays. Leverage new capital into growth plays, divest from decline assets and decline plays, and then evaluate the stable and/or harvest mode plays. and maintain the right equipment. So over the course of that period of time, that was a significant amount of progress in leveraging into the right basins and divesting out of other basins and other plays. And then here's our third look, and I think this is the most counterintuitive part of the strategy. We grew the business by declining our customer base. Now, you can probably see that these strategies go hand in hand: invest in the right equipment, invest in the right plays, and choose to partner with customers that are differentiated. But from 2011 to 2024, even though we grew the horsepower markedly, despite several investments and divestitures, we reduced our customer count from 904 to 255. The strategy was pretty simple. We could not be all things to all customers all the time. We had to pick and choose which customers were going to most value the partnership that we brought to the table and leverage those relationships by having a deeper, more entrenched relationship to provide higher quality and candidly more services to the larger customers. So you can also see we more than doubled our position with each of our top 10 customers at the same time. And so this was a tremendously successful strategy for us. And when you put all these strategies together, leverage against large horsepower, leverage against growth plays, leverage against growth customers with a deeper position, it's resulting in a level of performance and stability that was beyond our forecasts as we tried to implement these long strategies. Now, this last one is more obvious, and this is the fourth strategic point I want to make, which is that we had to invest in the right technology. Fortunately, the Internet of Things, the availability of telemetry, the cost effectiveness of communications has really revolutionized what we can do on our equipment. Now that we had the right equipment in the right place, with the right customers, we can make the investment to add telemetry to all of our equipment, communications capabilities, and deep operational opportunities to use instantaneous communication for both and for all of better communication with our customers, more responsive customer service, and more predictive and preventative maintenance. So the impact of the investments that we were able to make in technology have yielded amazing operational capabilities. What we get to deliver today for our customers is not just a better level of service, it's actually more service. We can differentiate really with great clarity between operational downtime caused by the compressor or operational downtime caused by production issues off the skid that are the customer's responsibility. And with that clarity, we can not just address our issues better, we can help our customer address their production issues better. So what we see in the data is that a compressor will go down about 6 to 7 times a month, 5 to 6 times for production-related issues that are not complicated to solve if you can have the clarity of knowing where the issue is caused. We also have the capability to make over-the-air changes and configurations to the equipment. When it gets hot in Texas, and in the summer when it gets hot, we can see what's going on with the compressor, and we can either automatically have it slow down, or we can also over the air slow down the units to keep them running. And then when the air cools down at night, we can turn the speed right back up, saving a ton of downtime for the customer and saving us at least 2 trips with the mechanic. So the operational benefits there for the customers are great. The operational efficiencies for the company are outstanding. And candidly, the lifestyle impact on our mechanics is also not to be underestimated in this labor market. So just an anecdote to illustrate the power of these investments in the company. And so you can see some of the benefits today, and because of timing, I'm gonna only hit a few of the comments. Profitability from 17 through 24, it's an estimate consistent with guidance. A 10% uplift in our overall gross margin performance. You can see that the investments we've made over a period of time did something that's really challenging to do, and that is we have de-aged our fleet even as we've grown it. 30-year equipment, 70-year-old company, you're swimming against the tide when you're working to de-age and improve the competitiveness of your equipment from an age perspective. We decreased the number of compression units by half and doubled the size of our horsepower. Utilization is at a record high. It's 95% as we exited Q3 of 2024. And you can see the impact over the last few years on our EBITDA as the chain has really caught on the sprocket and the company is performing at really a most outstanding level for the benefit of our customers and our investors. So those are some of the highlights, and I didn't really want to emphasize the financial performance as I wanted to highlight the deep operational work that it has taken to allow us to get here. Again, it's an outstanding market, but the company is performing outstandingly well in such a great market is really a part that I wanted to emphasize. And it's put us in the position to increase our dividend and pay out to our investors consistently over the last 3 years, and while maintaining very robust dividend coverage. And I'm going to point out our leverage position is also within our target range of between 3 and 3.5 times. So from a financial perspective right now, we really have a company that's performing on all cylinders. I think it's the market, and candidly, I think it's the vessel that we've built and the team that we've built over this period of time that's put us in this position. So I'm going to turn to the market and share with you our perspective, which is not going to be news. And what we see is a very durable upside in demand for natural gas and for compression. The compression is required. And it's really simple. The world is short of power. Natural gas is a fantastic, cleaner fuel to help provide that power. And the growth that we get to see in natural gas correlates in a very direct correlation to compression demand. So we see it as a very robust growth ahead. We see 10% growth between 2023 and 2030, and we intend to invest to capture that growth for the benefit of our customers. As you've read, most of that demand is coming from LNG, and notwithstanding the deep sea controversy over the last few weeks, what we would share with you is that 6 months ago, none of us even counted data center demand. It's so current. Nobody knows how much is going to be there. We only know there's a robust level of growth ahead for LNG alone, and there is some growth available for the data center demand and the AI engines, whether it's 3 BCF a day or 10 BCF a day. I don't think anybody knows quite yet. Everybody is sorting it out. But in any event, it's an incremental gust in the tailwind that we're experiencing in this market ahead. And so you can see what we are banking on for a forecast between 2023 and 2030. Longer term, we also know that natural gas is well positioned to continue to be a consistent portion of the growing energy demand. And we see growth ahead of 33% through 2050. So very stable growth in natural gas production is expected. And here's the thing that I'm going to hit kind of hard, and I think it's in addition to the deep strategy look I wanted to share, is the perspective that if we really want to reduce CO2 emissions in the world, we absolutely should rely on more US produced natural gas and continue to export it globally. Nothing has helped to reduce CO2 emissions in the US more than the production of natural gas to displace coal. And you can see on that top chart the impact we've had, that while natural gas production is up about 110% between 2005 and 2023, emissions are down 20%. That's the power of using natural gas to displace coal. For NOx, very similarly, we have to do a good job. In fact, the major thesis I'd share with you is that as an industry, we can solve problems like no one can solve problems. The oil and gas industry has an incredible bench and depth of technical talent and expertise to produce hydrocarbons, absolutely, but also to help invest in mitigating the effects of emissions in the future. Without engaging in the political debate, whether you buy into the impact on climate directly or not, to renew our social license and to continue to produce and use hydrocarbons throughout the globe, it's incumbent upon us to do the best job we can to invest in all of the technically available and commercially reasonable technologies that we can acquire to help reduce both pollutants and emissions. And if in the US we figure out how to do it well, absolutely the world will follow. So we have that opportunity ahead of us. And at Archrock, we are very invested in doing our part. So you can see what we've already taken as steps, which is to invest in larger horsepower, the most NOx limited emitting horsepower, investing in older horsepower that is not as emissions focused, not as powerful, not as clean burning, to establish a new ventures team to invest in not just electrifying our fleets, which limits the direct emissions in the field, but also to invest in additional technologies that can reduce emissions going forward. And let me share a few of those investments with you. So number one, last year in August, we acquired TOPS that increased the number of units in our fleet that are electric units from 4% to 35%. Now that pushes all the emissions, clearly that pushes them down to the power plant, but at the power plant, we know everybody will, a lot of the industry will be looking at investing in CO2 capture at scale. So we can't solve all the problems, we're just trying to solve it at the compressor. And this does solve it at the compressor location. The other thing we did is we did the whiteboard exercise a few years back and stepped back and looked at, okay, where are emissions coming from and what can we do about it? So number one, out of the stack, the engine exhaust, you can see CO2, methane, and VOCs. Then there are leaks, fugitive leaks, primarily of methane coming out of the compressor, but also out of the engine. And then finally, in normal operations, packing leaks and blowdowns generate emissions, the emission of methane into the atmosphere. And so we asked the question, what can we do about this? Well, we're dependent upon the engine OEMs, candidly, to take on what's coming out of the stack or to invest in carbon capture to capture what's coming out of the stack. So that one is probably not within the expertise of an operating company like Archrock to deal with. Fugitive leaks, on the other hand, there's no excuse why we can't make sure that we keep the methane in the pipe and provide the right technologies to the industry to do a better job of keeping the methane in the pipe. And the same thing with blowdowns and rod packing. There's no reason why we can't evaluate how to keep that in the compressor or in the production line. So that's what we've done. And here are a few of the investments that we've made to do so. So I'm going to start actually on your right, the Carbon Hawk. This is a device developed by Archrock, which connects directly to the compressor and captures all blowdown gas and packing gas and puts it back into the production line. A highly cost-effective solution for our customers that really want to have a zero methane, a zero emission compression operation. I'll show you another picture of that in a second. The second thing we've invested in is we took a minority position in a company called Ecotech, who has an outstanding array of technologies to provide LDAR. It's much more cost-effective than OGI, and it's very deadly accurate to show up on location for safety reasons, for operational reasons, as well as for LDAR, leak detection and repair work, to keep the methane in the pipe. And then finally, the longest lead is we've invested in a company that has developing technologies called Ionata, who's looking at trying to develop this technology to capture CO2 from the compression location at small scale and cost effectively. That's going to be in the below the $80 per ton range is the target for us. And we're working on that technology. That's the furthest one out there, the one I can talk about the least. But in looking at these devices, this just gives you a shot of what we've developed and what we've invested in. On the Carbon Hawk, very cost-effective device that sits alongside a number of compressors that can capture packing gas as well as blowdown gas. It doesn't require any power. It's just a mechanical process, and one we're very excited about. We are just now in initial commercial application of these units with our customer base, and we've seen some excitement for the unit, so we're excited about it. We're more excited about what it can do for the industry, candidly. We're as excited about what it can do for industry as we are about what it can do for Archrock. Then you can see the device, one of the tools out of Ecotech called the Gazo Scan, which is a point and shoot methane detection tool. And then you can see a rendering of what the Ionata carbon capture system might look like for the future. So I hope with that introduction, it feeds some questions for Uday and for you guys as to what Archrock has been working on, what we've done, the results we're seeing, and now what we're working on in addition to that past. So with that, thank you very much. I'll join you for questions. Where would you like me?
We've been doing a lot of work in, broadly speaking, the gas gathering, compression, distribution space, but never fully appreciated this operational complexity associated with the fleet and the variations and the configurations of the fleet. And it probably has a big impact in a business where costs matter, right? And where pricing is very subject to what broad industry capacity looks like, utilization rates, and what the overall industry dynamics were. So maybe can you tell us a little bit more, like operationally, what did that look like? Like, was it bringing the right talent that goes and looks at what the fleet looks like and organizes it? And it probably took a long time, and you alluded to that a little bit. But maybe, I guess, let's maybe give us a little bit more detail on that operational transformation.
I think what was maybe one of the earliest epiphanies on that operational complexity around the fleet was to step back and recognize that the business is a customer service business, but that it's also an asset management business. Now, I've never worked for another leasing or another asset business, think about other asset intensive businesses and maybe even leasing businesses. I don't love the comparison because we consider ourselves to be an energy infrastructure company first and foremost, providing service to our customers. But since we use an asset to do that, there's an asset management part of the business that I think was under-recognized and under-evaluated for a period of time. So whether it's rail cars or automobiles, transportation, heavy transportation, all of these are asset businesses, and the underlying assets themselves drive your performance in a significant way. So I don't know this, but I expect that at a more sophisticated place than maybe we are, that, and I'll pick Hertz, they have a model that says to maximize the revenue and the value of one of their investments, they're going to operate it and lease it for 3.2 years, and they're going to sell it in month 48, and that maximizes their overall revenue. So in our business, we basically evaluated the same thing as we look at generations of equipment. Caterpillar does an excellent job of making a more efficient engine about every 7 years, which means that the prior batch is not as in demand as the current batch. And so there's a certain number in every category that you want to maintain for overall value over the life of any single asset, and you want to have the right tools within the portfolio to manage the assets to try to pinpoint that period of time when you should buy, hold, sell. And so recognizing that fleet asset management requirement is one of the things that shows up in the data. And so the strategy around standardization was an outcome of that. But what really preceded that was the work done by the team with help, but with outside help, to evaluate the fleet position and determine that we needed better asset management tools to really maximize the overall cash value of every unit over its life, of every category and class of units over its performance life.
That's helpful. So when you look at growth drivers, right? So LNG obviously has been a growth driver for a long period of time now, potentially power generation demand because of data centers. Does the natural gas production, gathering, distribution, businesses look different, whether you are serving an LNG export market versus, let's say, a data center power generation market? And does that then spill over back into what that means for the kinds of customers that you are serving, what kinds of fleets they are leasing? Operationally, do they think differently? I wonder if the growth drivers have an impact on your business.
The straightforward answer is not really.
Okay.
We are too far upstream in the oil field and a part of the natural gas production and oil production cycle to really see that far down to the end-use markets. It does, however, mean that in positioning in basins and with customers, we try to seek the best intel we can to know which customers are more likely to get commitments to supply the gas going into the growth area, including LNG. Some customers are candidly not positioned well on infrastructure, and other customers are better positioned on infrastructure. But that's just an intelligence gathering exercise. I think we've been as wrong as many times as we've been right, but that's we still try.
Okay. So, but like, for example, if you're serving, let's say, pipelines that are feeding into, or you're serving midstream operators that are gathering gas and feeding into pipelines, feeding LNG export terminals, is there maybe a greater willingness to pay, let's say, a premium because you have a fleet that is much cleaner, has better fugitive emission control and things like that? Do you see those kinds of trends?
We're not seeing those trends as directly right now, and the other compliment I want to pay is the industry overall. One of the things that is standing out right now about the compression business, and it's not just Archrock, in fairness, our competition and our key competitors are doing an excellent job also. What we believe has happened is that we have top-tier customers, large IOCs, independents, and they demand excellent performance in midstreamers. And the level of performance that the industry is offering has never been better. I believe we've never been better, but also know our competition is doing a good job too. And that's a good thing for the industry. And it's a good thing for us as well. There's nothing better than having a well-organized, disciplined market with good competition. It allows us to understand how to invest well, how to partner with our customers well, and it allows our customers to depend upon our services with more security rather than less. But that differentiation is not yet there as well as we want it to be there. I do believe that since we're early innings and really exploiting the data-heavy investments we've made in communications and in technology, that differentiation is going to be there. We're invested in it. I intend to win, so let's be clear. But I think some of that is still ahead of us.
But do you see your investments in methane emission reduction also as a differentiating strategy relative to competition, or do you think most of your peers, at least the larger peers, are also responding in a similar way?
I believe we are leading the investment in emissions technology right now in our space. I don't think it's had enough time to be impactful yet. As I mentioned, the Carbon Hawk, we're just in the early commercialization phases of that product. The Ecotech tools are competing nicely with other monitoring technologies that are out there, but the industry is still just starting to really invest in this. But the important point is that we actually would be happy to provide our competition at market rates, arm's length basis with everything we do, if they were willing to engage in it. Our goal is to invest in technologies that could perpetuate the use of abundant, available, affordable natural gas for as long as it competes well to provide a cornerstone fuel for power generation. And the more we can invest and continue our social license to operate in hydrocarbons by doing a great job on emissions and pollutants, the longer we can perpetuate the value of our company and billions of dollars of infrastructure in the industry. So these technologies are going to compete cost effectively, but we are not going to hoard the technologies. We want to make sure that everybody who wishes to commercially can exploit these technologies.
On electrifying the drivers for the compression fleet, right? For example, the acquisition of TOPS. Can you give us a little bit of thinking, like why did you make that acquisition? What were the underlying drivers? I mean, obviously they have great coverage in the Permian, so that aligns nicely with some of the markets that you want to grow in, and also markets where gas is growing quite rapidly. But the electrification of the fleet, was that a driver, and why is that a driver?
So we have been operating electric motor drive compressors primarily in the Rockies for more than a decade. And for emissions reasons, the Rocky was leading edge in the investment in electric motor drives. So we are very comfortable operating electric motor drives, but there's still quite a bit of learning. So there are a few reasons that were really critical to acquiring TOPS. So, number one, we believe the oil field will continue to electrify as power is available. We know the grid and investment in power is a gating item for that, and yet we still see good growth. Going forward with demand from our customers, approximately 40% of our new build CapEx will be for electric motor drives. That's driven by our customers. That's as much as that is a strategic decision for us. But because we think that electric motor drives have a longer future life than the volume of natural gas fired compressors we see in the field. We're very happy to leverage with those customers that really want to grow their electric motor drive applications. So we see that as a natural growth area. TOPS allowed us to expand that in one nice acquisition. Second, TOPS had acquired expertise in electric motor drives that was ahead of us. There is a certain amount of complexity, and I'm going to be over my skis real fast if I go too far on this. There's a certain amount of complexity around sizing electric motor drives and powering them based upon the size of the unit, the demands of the location, and the available power of the location. And TOPS had a team of electricians already on staff that have solved some of these problems. In addition, they had a fantastic control technology on their compressors that was very similar to what we were doing on the gas side. And we thought the combination of these communications and telemetry and automation capabilities was something that they were ahead of us on. And so we wanted to acquire that and bring that into our portfolio. And then last, I'm going to point out, we were very public about this, it was a very well-priced acquisition. We acquired this for, I think we reported publicly 7.3 times EBITDA, and we trade well above that. So, just significantly positive arbitrage for us to acquire a young, growth-oriented electric motor drive fleet with great technology capabilities.
So on that, I guess, are there more acquisitions down the road? Because the industry is fairly consolidated, right? I mean, if I remember some of the work that we did in contract compression 10 years ago, there's like lots and lots of players, lots of surplus capacity, prices, rental rates were really down. But the industry has done a great job of consolidating itself. There are now 3, I guess, leading players that account for 70-75% market share. And then there's still a long tail, but it's much smaller players. And a lot of the large players now have a lot of capital, fairly good looking balance sheets. I mean, Archrock definitely does. So I wonder, is there more consolidation that you think will occur, or this is about it?
There's the obvious no comment on anything specifically, but just from a policy perspective or a general perspective, number one, no one has our balance sheet. That's one of the advantages we have right now, which means no one has our financial flexibility and ability to move in the space. So you're right about how the market is consolidated at the top. At the same time, the market's grown. So there's 50 million horsepower out there operating, and we don't operate all of it. And even though the top 3 are the most dominant from a size perspective and likely customer penetration perspective, I think there probably has never been more compression companies than there are today. So there is still some small startups that have done a nice job in different areas. TOPS is a good example of that. So on the one hand, we have, just from a public perspective, nothing that we can talk about publicly. And at the same time, if there are opportunities to consolidate with competitive horsepower that's well positioned in the right basin with the right customers, we'll evaluate it, and we intend to remain aggressive.
Okay. I have one more question, but I'm going to open this up to the audience. So as questions bubble up, we can take some questions here, but I guess
appreciate the insight. I think you painted a rosy picture of the demand curve going forward. I'd be really interested to know how you think about supply risks. Maybe even take like a limit argument. Maybe the Ukraine-Russia situation moves to the point where Russia's putting all this stuff back on the market and at a low cost to try to rebuild their country as maybe a black swan event. But how do you think about supply side risk in the next 10 years?
Sure. Thank you for the question. There are definitely market risks, black swan events that we could all talk about. It's just that I can't talk about them with any more knowledge than you can read about them, right? So, but on the supply side, it's a really interesting question. What we're looking at, we're only a lower 48, North America business, and so the supply of natural gas is not constrained other than by pipelines temporarily, and we see enough pipe going into the Permian to alleviate and to take on and export as much natural gas as is needed to support the scenarios that we depicted. And so we don't see that as a risk. The thing I would point out about natural gas is that the risk really is on the demand side. I get asked a question pretty often, which is, what's the impact of natural gas price on your business? And what I would share with you is that counterintuitively, it's not a very strong correlation. On a short-term basis, it can drive some of our customers in dry gas plays. We're 70% leveraged to associated gas, which means only 30% of our business has that exposure. And of that 30%, we're still leveraged to production, and production doesn't usually go down. Growth in production just halts or reduces. And so our leverage to the price swings is very low, and it's for a really simple reason, and that is that today natural gas is a demand-pulled economy. It is not a supply-driven economy because of the amount of abundance, affordability, and availability. So the only thing that really impacts that for us is the short-term constraints that appear when pipe is not yet available for the customer to transport gas. I know that wasn't a direct answer, but that was hopefully responsive.
More questions? Well, okay, Chris.
I have a question regarding, you're moving strongly towards electric generation or electric compressors. About exactly 4 years ago, we had Winter Storm Uri, and a lot of the gas-fired power plants that went down, they blamed it on, electric compressors that were buying interruptible power, and they were curtailed, and so they couldn't get the gas to the power plant. So I'm kind of curious to know, is there a risk of going in that direction? How do we avoid another Winter Storm Uri situation where we can't get the gas to the power plants?
So I'm very happy and excited to share with you that I do not speak for ERCOT or for the strength of the overall Texas power grid, but I can give you an observation that I think is part of the problem that appeared during Uri, and that is that ERCOT shut down power that was supplying compression, so then the compression went down. And I think that ERCOT has reversed that policy, and they understand that they can't shut down in that scenario, that they're going to have to operate. The second thing, and we worked with some of our customers on this directly at the direction of ERCOT for them, and that is that we have made investments, and we've helped our customers make investments in hardening and protecting their assets from going down during a freeze. And so we've added in more heating elements and more insulation to several locations, or better said, we have seen our customers do that so that we can continue operating more consistently despite it. So your observation, I completely agree with. It's a risk, and I think that ERCOT is directing industry to take steps, and I think industry is taking steps to help mitigate that risk if we have a future Uri event.
More questions? Annie?
Hi, Brad.
Hi.
Thank you for the wonderful presentation. My question is related to the supply chain question that was asked earlier. I think currently Archrock's fleet is heavily dependent on one compressor OEM. And as you're talking about electrification, probably, right, you're also diversifying the driver aspect of it from Caterpillar or Waukesha, whatever. How do you see that reliance on one OEM?
Thank you for the question. A couple of things. I'm equally happy to tell you that I do not speak for Caterpillar, so I want to be careful, but I'd share with you that Caterpillar is an outstanding supplier. It's an incredibly well-run company with great supply chain depth. And even during the COVID period, now demand was down, so they didn't have the challenges that we have today. Caterpillar did an excellent job of meeting demand. Now, lead times did extend out for sure, but they still kept the lines running and were able to supply most of the market need. Maybe not in the time frame exactly that the market wanted, but they supplied most of the need. Both Ariel is the main OEM for our compressors, and Caterpillar for the gas engines that we use. We also source from Waukesha as well as Cummins. They did have some steel supply problems, and they had a few of their vendors that did not do well in COVID that supplied primarily bolts, by the way. Just we couldn't find bolts. It was one of the constraints at the time. But they addressed that concern by insourcing a lot of that supply. So in the scenario and for the future, I think they've tried to address that as well. And then finally, I'm going to point out that notwithstanding that these are all excellent companies that do a great job, we are diversifying our supply chain with electric motors, and those are available from more OEMs than gas engines. There are at least 5 to 7 manufacturers of good equipment. So we are diversifying that supply base. So we have not seen this as a major risk for the availability of units. It's expressed itself as a problem at times for the supply of parts, and we believe that it should be better handled. It should be well in hand for the next time. But we'll have to pause and say we don't know the exact impact of tariffs, and so we're all working together to figure out what that might look like.
Well, excellent.
There's one over here.
There's one more. Okay.
Yeah, sorry if you can fit me in.
No, sure.
One quick question. Congratulations on all the success, and very interesting to see how intentional you've been with your strategy and how that has led to your success. I would ask, what about international? Do you see Archrock expanding into international markets? And if not, what are the kind of considerations from a strategy perspective on whether it's a good fit for Archrock or not?
Thank you for the question. So when we operated as Exterran, we had international operations, deep in Latin America, Brazil, Argentina, Mexico primarily, a little bit Peru. We had in the Middle East, including Iraq during a very hot time, Bahrain, and the Emirates, and then in Asia with the largest operation in the Gulf of Thailand. And so the team has experience managing those assets. And what I would say is that having had the experience of managing those assets, we have some amazing investment opportunities to say grace over in the United States. And we want to exploit those first. Foreign jurisdictions are complicated. In some jurisdictions, it's like the Hotel California, the capital goes in and it never comes out. So in other jurisdictions, there are surface hostilities to be navigated. In other jurisdictions, there is a level of corruption to be navigated. And so with so many rich investment opportunities that we're excited about in the United States, some of which I got to share with you today, we don't see ourselves moving into the international markets anytime soon.
Excellent. Brad, thank you so much. Fascinating discussion. It's a very different perspective. We usually get speakers from operating companies, but very interesting perspective of the natural gas space. Deeply grateful, and thanks for your patience and understanding during the technical issues. But thank you for doing this.
It was my pleasure. Thank you.
Let's give Brad a hand.
Thank you.